Today, we are diving headfirst into one of the absolute most critical economic reports of the week and mapping out exactly how it could impact your portfolio. The financial world is watching this one incredibly closely. Whether you're heavily invested in tech stocks, holding on to gold, or navigating the wild swings of the crypto markets, the macro data we're unpacking today has the undeniable power to send ripples across literally every major asset class. We all know the broader environment has been super tense lately, right? Well, this print could be the exact catalyst that decides the market's direction for the rest of the quarter.
The clock is officially ticking down to this exact moment, August 12th at 8:30 a.m. Eastern Time. That is when the U.S. Bureau of Labor Statistics drops the July Consumer Price Index. For seasoned investors and algorithmic trading bots alike, this isn't just another economic stat crossing the wire. It's the crucial missing puzzle piece that's going to definitively set the stage for the Federal Reserve's next move on interest rates. We are talking about billions of dollars in capital positioned to react the millisecond this data goes live.
To make sense of this massive data drop, we've structured our explainer today into 5 clear steps. The CPI countdown, unpacking the numbers, 3 market scenarios, the energy wildcard, and finally, the Fed's next move. Let's jump right in. Starting off with Section 1, the CPI countdown. Let's look at exactly why this specific CPI report has global markets holding their breath. 2%. This single number is the Federal Reserve's long-term inflation goal. As we all know, getting inflation down from its peak, that was the easy part. It's this final stretch that's proving to be so incredibly difficult. With inflation remaining stubbornly above this target, Fed officials are anxiously watching to see if price pressures are finally, sustainably moving downward. It is the ultimate benchmark for success in their fight against rising prices, and markets are pricing in a lot of hope that we're finally closing in on it.
Moving on to Section 2, unpacking the numbers. What's really fascinating about how we measure this target is the data itself, so let's unpack it.
Just as a quick refresher, before we look at the forecasts, we need to ground ourselves in what CPI actually is. It's a tracker for the everyday costs you and I face, a direct quantitative gauge on changing prices for a broad basket of goods and services. It acts like a massive temperature check on consumer purchasing power, pulled together from tens of thousands of data points collected every single month.
This really illustrates just how broad this metric is. It touches everything from the gas in your car to the food on your table, housing, medical care, you name it. It's the ultimate snapshot of the cost of living. But what makes it so interesting for traders is how these categories interact. For example, if we see sustained spikes in transportation, that can easily bleed into the cost of food and apparel, creating this cascading effect that keeps the overall number elevated, even if individual sectors start to cool down.
Now, as you probably know, the market splits its focus here. We have headline CPI, which includes the immediate pain consumers feel at the pump and the grocery store, and then we have core CPI, which strips out those notoriously volatile food and energy categories. When major geopolitical shifts happen, headline CPI can swing wildly. But core CPI, that's what tells the central bank whether inflation is actually getting sticky and embedding itself deep into the broader service economy. So, heading into the report, we have some very clear consensus expectations. Looking at one forecast cited by Kiplinger, economists expect headline CPI to rise just 0.1% month over month, which would keep the year-over-year figure at 3.4%. Core CPI is expected to rise 0.32% for the month, settling at 2.5% year-over-year. But remember, the institutional reaction won't just be about whether inflation is generally up or down. It's entirely a game of expectations. The market's next move hinges heavily on the delta between these specific forecasts and the actual print.
That brings us to Section 3, 3 market scenarios. Let's map out the 3 distinct ways the market could react once these numbers hit the wire.
In our first scenario, the CPI report comes in significantly below expectations. This cooler inflation suggests that the tightening cycle has successfully worked its way through the economy and price pressures are truly moderating. For Wall Street, this sends a huge, powerful signal that the Fed may finally have the macroeconomic room it needs to comfortably ease policy and start cutting interest rates. If we see this cooler data, the ripple effects are going to be massive and immediate. Expectations for rate cuts would absolutely shoot up. Risk assets like tech stocks and growth stocks get a major boost because lower interest rates reduce the discount applied to their future earnings. We'd likely see bond yields fall, the US dollar weaken, and, this is super interesting, non-yielding assets like gold and Bitcoin could receive massive additional support as risk appetite expands. The second possibility is that the numbers land right on target, perfectly matching economists' forecasts. This scenario would likely produce a much more muted, sideways market reaction.
But make no mistake, even with a matching number, traders aren't just going to pack up and go home. While the immediate reaction might be quiet, it reinforces the current higher-for-longer outlook. Analysts will instantly dig underneath the headline number to see if stubborn areas, like shelter costs or services, are remaining sticky. Their focus will immediately shift to upcoming employment and wage data, hunting for any sign of weakness that might force the Fed's hand.
Things become much more complicated in our third scenario. If inflation comes in significantly hotter than expected, it flips the entire market narrative on its head. We go from asking, when will the Fed cut rates, to a much more terrifying question for investors: will they be able to cut rates at all?
A hot report acts like a bucket of ice water on a market rally. Expectations for rate cuts would instantly drop as stagflation fears creep back in. Treasury yields would push higher, strengthening the dollar. That recent tech-led stock rally? It would come under intense pressure because high valuations are incredibly hard to justify with elevated discount rates. Bitcoin could experience crazy volatility as liquidity tightens, and gold would face competing forces, supported by long-term inflation fears, but pressured in the short term by those rising Treasury yields.
Let's pivot to Section 4, the energy wildcard. Because even if the core numbers look fantastic today, there is a massive threat lurking in the background.
Traders are watching energy prices like a hawk right now. With rising geopolitical tensions in the Middle East, specifically surrounding the Strait of Hormuz, crude oil prices are being pushed higher. This matters immensely because energy prices can influence overall consumer inflation incredibly quickly. It completely bypasses the normal lag effects we see in things like housing data.
Look at how this domino effect builds through the economy. Step 1, higher fuel costs directly hit household budgets at the pump. Step 2, this spikes global shipping and logistics expenses, from giant ocean freighters right down to final-mile delivery trucks. And Step 3, businesses just pass those increased transportation costs right onto you at the checkout line. It's a vicious second-round inflation effect that can unravel months of tight monetary policy in a matter of weeks.
Which brings us perfectly to our final section, Section 5, the Fed's next move. Let's zoom out and look at the difficult balancing act going on right now.
The Fed is literally caught between a rock and a hard place trying to navigate their dual mandate. On one hand, recent data points to a weakening U.S. labor market, which strongly argues for lowering rates to prevent a recession. But on the other hand, inflation still hasn't hit their target, which argues for keeping policy extremely tight. They have to balance price stability perfectly with maximum employment, and honestly, the margin for error here is razor thin.
This balancing act is exactly why the markets are so on edge. After recent weaker-than-expected employment data, Fed funds futures were pricing in only a 48% chance of a September rate hike as of August 11th. That means today's CPI report has the undeniable power to swing those odds drastically in either direction, dictating billions in bond market positioning.
As we wrap up this explainer, it's absolutely vital to remember this exact perspective. While today's data release is a critical catalyst, one single CPI report does not determine the entire inflation story. The Fed is also going to heavily weigh upcoming PCE data, wage growth, consumer spending, and overall economic growth before making their final binding decision.
Ultimately, everything hinges on this one massive question. Is inflation moving sustainably toward that 2% target, or are new energy and geopolitical pressures about to push it right back up? How the data answers this question will dictate the next major move for stocks, bonds, gold, Bitcoin, and the US dollar. Keep a really close eye on these numbers, and thank you so much for joining us for this explainer.